Wire and cables manufacturer Polycab has had a resilient Q2 FY21. With consumer sentiments having rebounded quite strongly after the initial drop, the business is showing encouraging signs of getting back on its feet. In our ideas for profit today, I'll discuss if the stock really warrants investors' attention post the Q2 earnings. While Polycab India's Q2 revenues declined 6% year-on-year to 2,114 crore rupees, the easing of the lockdown restrictions and pickup in the consumer sentiments together supported the top line this time in the quarter gone by. Now, EBITDA also increased 16% year-on-year to 312 crore rupees, and that's on the account of the margin expansion which we've seen across the business lines. There's healthy performance on the operational front as well, which also has aided the bottom line, which increased 15% year-on-year to about 221 crore rupees. Now, on a sequential basis, the wires and cables segment fared well during Q2 as well. Although the pressure in the institutional channels remained in place due to the pandemic, while the B2C, that's business to consumer sales, grew in high double digits, the revenues from B2B, that's business to business segment, declined 30 to 40%. Now, owing to the sluggish construction activity, exports bounced back quite strongly. That's up 47% year on year, owing to the healthy offtake, and that's across all geographies. US, Australia, Asia, and also Middle East. Now, retail-focused FMEG, the fast-moving electrical goods segment, also had its revenues grow about 25% year-on-year on the back of augmentation of the distribution network, also the expansion of the product portfolio. EPC, that's the engineering, procurement, and construction segment, that remained a drag on the company's overall performance, underscoring a mixed picture of the economy at the end of the quarter. Now, margins and profitability improved across business segments, so that's a positive. Reduction in employee expenses, also curtailment of ad spends, pullback in the dealer incentives, altogether have supported the overall margin profile as well. Now, in the domestic market, the retail demand across tier 1, 2 and 3 cities and rural markets are really picking up. However, consumer footfalls and also the sales continue to lag in the large metros. Polycab has been focusing on the launching of new products and is looking at improving its margin profile through premiumization as well. Now, after a brief pause in order inflows, they have actually recommenced during the July to September period. In Q2, Polycab bagged a follow-up order of say 70-75 crore rupees from Dangote, and also besides this, the company has a healthy order pipeline that's from US, Australia, and also from the other markets as well. Now, the capex for FY21 is pegged at about 200 crore rupees, and the investment will be directed towards the backward integration of the company, also debottlenecking, and also adding newer product lines as well going forward from here. Now, Polycab's balance sheet is quite robust with the adequate capital buffer to really manage the industrial downturn which we are seeing. While the cash flows have really weakened due to the working capital challenges, the business has really got an abundant liquidity at the point in time, and also the net cash position at the end of September stood in the excess of 600 crore rupees. So that's another positive. So Polycab is a market leader in the wires and cables business, giving it a strong, solid, long-term footing. Considering the rapid retail footprint also expansion which is underway and the initiatives in place to really capture the share across the export markets as well, Polycab is really well positioned to gain from the premiumization of the economies of scale that will lead to significant margin expansion also and improved profitability going forward. However, the outlook for FY21 remains quite challenging, and that's owing to the macro concerns which arises from the pandemic, which is not going away anytime soon. So that's a complete overhang that we need to watch out for. Despite the ongoing headwinds, however, the valuations at 20 times FY22 earnings seem quite reasonable, and the stock seems a very good bet for the long haul, as the business has a robust performance portfolio and proven execution capabilities.